So let's start with our first mode, profitability. The easiest and the most intuitive way to understand the moat of the company. Essentially, we are looking at how much profit company earns from each dollar or rupee of sales. Say for example, you read a statement that the net profit ratio of Apple is 30%. What does it mean? It is just a simple way of saying that for every dollar of sale which Apple makes, it is earning 30 cents on that dollar. One of the most common mistakes people do is just look at what? At the bottom line. That is net profit. What we don't realize is that there are different types of profits and they tell very different things about the company. These types are gross profit, operating profit, and net profit. And just like this ice cream cone, they can be found on top of each other in the income statement of the company. Here is a simple example. Let's assume a company sells mobile phones and they have sales of around 1000 rupees or $1000 in a year. The cost of making that phone, that is the raw material, the labor, factory costs like electricity, that is all comes out to be around 600 rupees. This cost of making this phone is called cost of goods sold. Now, gross profit is simply calculated by taking sales and reducing the cost of making that good or providing that service. That is 1000 rupees minus 600 rupees is equal to 400 rupees. Now, company after making the product has to do marketing to sell that phone. To do that, they hire managers, they hire managers, they buy ads, they hire other employees like accounting staff, etc. for its offices. They pay rent, etc. All these expenses is called selling, general and administrative expenses, or a short form of S, G and A expenses. We deduct these expenses from the gross profit to get operating profit. So in this case, the S, G and A expenses is 100 rupees. So our operating profit is 300 rupees. From this operating profit, now you will deduct other expenses. What are other expenses? Let's say for example, you have taken loans in this company for your working capital. Now you have to pay interest on those loans. So that interest payment will come as other expense. On the flip side, if you had made any investments, then what you will get is income from those investments. So you will get other incomes and other expenses. Let's assume that in our case, it is a net expense of 50 rupees. So after deducting the other income expenses from operating profit, we will get profit before tax or 250 rupees. And then you have to pay taxes. After paying the taxes, you get what we called net profit. This net profit is what company has earned after deducting all the expenses. But the reality is, this net profit is not telling you the complete picture. To understand the complete picture, you should try to look at the company's profit in this way. And so just like this ice cream cone, these profits are on top of each other. And they tell a very specific thing about the company. GP is telling you how much profitable the company is after just selling its product. That is the margins the company is enjoying on its product. Operating profit is telling you how much the company is spending on its operations to sell that product for marketing, for general expenses, administrative expenses. And net profit is telling you what is the net profit after everything has been deducted, what the company is earning after all that time. Let's take a real life example. Let's look at the income statement of Gillette India Limited. Now Gillette India Limited has revenue from operations of 2009 crores in the period ending June 21. It has other income of 31 crores. Remember, this is not your operating income. This is the income which is earned on other things, maybe like investments, etc. And this year total revenue is 2041 crores. The cost of goods sold for generating this 2009 revenue is cost of material consumed and purchases, and we get cost of goods sold at 899 crores. So a gross profit will be calculated by taking the operating revenues and deducting the cost of goods sold. And we get the gross profit of 1110 crores. From this, we will start deducting the operating expenses. Operating expenses are what? Your salaries, which are in the form of employee benefit expenses, the depreciation on the machineries in your factories, which is 57.52 crores, and other operating expenses like marketing, like your accounting staff salaries, your rents, all of these things are combined here as operating expenses. And you take the gross profit and you deduct all the expenses and you get operating profit of 402.98 crores. From there, you deduct what? You deduct your finance cost. Finance cost basically means other expenses which are not part of your operating cost. And this 5.25 crores. And what is the other income? This 31 crores. This is the income which was other than the operating revenues. So what you will do to calculate profit before tax is simply you take operating profits. You deduct this 5.25 crores, that is your other expense, and you add your other income of 31 crores. And what do you get? You get profit before tax of 429 crores. Now this profit before tax, you have to pay tax on that profit. That tax is around 119 crores. And your net profit, that is profit after tax, is 310 crores. So you see, there are so many different ways to look at the statement. So you see, this is how you can look at the income statement of Gillette very differently. A normal person will look at the statement and says that the Gillette has earned revenue of 2041 crores and it has earned a net profit of 310 crores. But how will we look at the statement? We will look at the statement and we will see that the Gillette has earned a profit of 1110 crores on the sale of 2009 crores. That is Gillette is earning a very high gross profit margin of 55%. But when we look at the operating profit, we see that the profit is reduced to just 20% of the revenue. That means that around 35% of the expenses are put in operating expenses. That is your marketing, selling in general, etc. So our operating profit is reduced to 20% despite our gross profit having a very high profit ratio of 55%. So it tells us that the company, even though having a very high margin product, has to incur a lot of expenses. For what? For marketing. For what? For selling its product to the consumer. That means Gillette is facing competition from other players to sell its product in the market.